Go ahead. Make my day.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. So glad you've chosen to join me today. Hopefully it'll be worth your time. I think it will be. I'm going to do my best. More interesting stuff. Usually I don't like to carry on the same conversation about the same topic over and over again. But there's just too much stuff, right? There's too many interesting things going on. And I think right now is a great time to get a better understanding of what's happening in the market. So we're going to cover some more interesting news relating to what's happening in different marketplaces across the country. Some interesting trends I'm seeing locally, both relating to rental rates and to sales prices, which I think kind of reinforces what we're seeing nationally and things I've talked about previously from an anecdotal standpoint. So it'll be kind of an interesting show, a little bit of a mishmash. And I think we are definitely crawling up on the time when it's appropriate for me to start doing some local market analysis shows. So I'm debating whether or not that's more of a visual thing. Because I want to be able to show you guys the data and talk about it in terms of graphs and charts and things like that. So I'm thinking that's going to be a YouTube thing. I actually had a listener who listens to the show on YouTube actually say they'd love to see a market analysis of the local area. And I think for those folks across the country, knowing what kind of market we have here, being able to spot some trends that are happening here could be indicators of larger things. So I think everybody could benefit. So I think that's definitely on the agenda. We're going to do that. But for right now, let's go ahead and cover these news items. Now let's start first with some things that just kind of hit my inbox. I subscribe to a lot of cool searches on Zillow and Trulia where I get alerts on things that are happening, and also in my own MLS tool. MLSlistings.com is the company that supplies the MLS stuff from my area, which really covers everything from San Francisco all the way down to Monterey and even a little broader than that. And it's been some interesting stuff. So let's hit the first one. This one came actually in my inbox on 10:30 this morning. Now I have a search that's running for rentals in my area, and just so you're aware, if you're somebody who wants to keep up to date on what's going on with rentals, let me strongly suggest, at least in my area, at least in Silicon Valley, having a real estate agent set up a search for you within the MLS for rentals is not productive. The vast majority of homes for rent do not end up in the MLS in Silicon Valley. There may be other places in the state or the country where that's not true, where the MLS is the great spot to find all the rentals. It isn't here though. So if you're somebody who wants to get a feel, and I would argue that just given the infrastructure of what Trulia and Zillow have, if you're someone who wants to get a feel for what the real estate market is doing, act like a renter, right? Act like a renter who's constantly shopping for a rental. So I like it because I'll create a search, and I'll create a search for my bread and butter property, right? What's my bread and butter property? 3 beds, 2 baths, right? So that's what I'll do it for. And then I just sort of let it go loose, and I get to see how much things are renting for in various areas. And then I will frequently star a ton of the properties that I think are interesting for one reason or another. And then when they go off of Zillow or Trulia, I get a note from them saying, "Hey, this just got rented." Awesome, right? If you're kind of tracking this data on your own, let's say you've written a cool little database in FileMaker, or you're using a spreadsheet, or you're noting it down in a notebook with a pencil, knowing what's going on and how long it took for these properties to come and go on the market is great information for you, right? Isn't it fantastic? And you should be doing this if you're a landlord in these areas too, setting up a search for a property that's as close to like yours as possible. tracking how long it's taking folks to get their homes rented, tracking what their price is. Over time, you may discover you're not charging nearly enough, right? And that you may discover that when these homes go up on Trulia or Zillow, I use Trulia. Trulia is my go-to. You may discover that folks that are charging a couple of $100s more are actually renting their homes in a couple of weeks. They may not even be on the market that long. So it might be something that gives you good data to realize it's time for you to raise your rent because the demand is so high at a higher price point. Okay, anyway, so that's a side note. But the other thing I look for is trends. What do I see in terms of pricing? Now, we had a little chat back in December, January timeframe, where I talked about where the average that I was seeing in terms of rental rates for a 3-bedroom, 2-bath home was right around $3,300 to $3,500 a month. Well, and then a few months later, April, May, June, right in that ballpark, I shared with you the fact I was seeing numbers more like 35 to 38. Well, now that has almost completely reversed itself. I'm seeing a whole bunch of properties now in some areas that are just nuts, right? We've talked about Sunnyvale as a crazy area, Santa Clara, Cupertino, and parts of San Jose that are just nuts. And I'm seeing 3-bedroom, 2-bath homes for $3,400, for instance, in Sunnyvale. 3 bedrooms, 2-bath in San Jose, $3,400. Now, are there more? Absolutely. And places like Mountain View, where it's going to cost you $5,000 or $6,000 to rent the same house, absolutely. But my point is, on average, I'm seeing an interesting slowness in terms of rental growth. In fact, I would say on average, rental rates that are currently available in Trulia are a much better deal than they were 6 months ago. That's the feeling I'm getting from the numbers I'm seeing. And it is obviously, this is a much more difficult thing to pin down because there's not a real central authority for number crunching on that stuff. And there's no official way to know why that property went off the market. The assumption is it rented, right? Of course, that would be the assumption. If someone posted a house for rent and then it went off of Trulia, you got to assume it rented, right? Now, the MLS is different. When it comes to sold homes, it's a different thing. The MLS is going to be involved in the vast majority of properties that sell, so the data is going to be better. You're going to know who rented it, or who listed it. You're going to know who sold it. You're going to know how much it sold for, how much the original asking price was. You're going to know all that stuff. Particularly if you're working with a realtor who has access to the data. So the number crunching there is going to be a little bit easier, and it's also going to be more exacting. But again, these are all good indicators. So that's number one, a softening in rental rates, which I find interesting. Now, what's also interesting is we talked last time about you being the higher preference, right? You offering the superior product, protecting you from some of the things that we were talking about relating to declines in rentals, right? With the apartment complex aspect of it. You'll always be the upgrade. When you take a look at these rentals, what you're finding is that the less sexy rentals, right? The older homes are renting for less, the homes less upgraded are renting for less, but the really beautiful homes, the well-maintained homes are renting for more. Now, of course, you're thinking, well, that just makes sense. Well, yeah, it didn't always make sense though. And this is what I'm trying to get at. I think we're at a point where, in general, we're seeing a softening. And we're going to talk about another piece of data here in a second that I think really also plays into this. In that we're still in that weird margin that exists, right? Where before we were way, way up in terms of demand, and supply was way, way lower than that, right? And now what we're doing is finding that even in these rental areas, it looks like what we're seeing is a tightening where there isn't that much difference anymore between the supply and the level of demand, which is causing folks to have to be more aggressive in their tactics to get things rented, right? And we're also seeing that happening in the selling market. So we're going to talk about that in a second, though. So the second piece of mail comes to us from the good folks at Zillow, where there is a home that's in, again, and this is in a very popular area, and this arrived at 7:58 this morning. A home that is just a 4-bedroom, 2-bath, 1,600 square foot home was originally $1,598,880 and has been dropped in price by almost 10 grand, $1,589,000. Okay, so there's that one. Then There was another one I got yesterday for a 2-bedroom, 2-bath condo in San Jose, gated community, where the price dropped from $599 to $520, right? So what is interesting about that? Well, first of all, it is playing into the parts of the market that I have suggested in the past would be where you'd see the softening first, right? We've already talked about luxury. Luxury's been taking a hit everywhere. It's not just my area. Luxury, if you're going to see properties being dropped in price, typically it's the luxury market. But what have I said about 2-bedroom properties in the past? They tend to be the least desirable of the residences. Now, we are talking about a condo here and not a house. But what's interesting is if you start to see the softening in a condo world, if the market continues to soften in that trend, you'll see the same problems start to occur with 2-bedroom single-family residential homes later, right? Remember, the things that tend to suffer first in a rental market, it's the apartments, the least desirable. In a single-family residential world, it's anything, single-family residential homes are always at the top in terms of preference. And then and at the top of that preference is usually 3-bedroom, 2 baths. Then dropping way down is 2-bedroom homes. Below single-family residential altogether is condos. And condos are at the bottom, right? It goes single-family residential at the top. Townhomes are next, or at least architecturally townhomes, right? I realize this is different across the country because here condominium is actually more of a legal definition. It's kind of a way you own it. You can have condominiums that look like a townhouse, but it's a condo in the way it's organized. In a condo, you own the airspace that's contained within the walls of your home. In a townhome, you own the ground that the townhome sits on going straight up, right? So that's kind of the difference. So in terms of desirability, the townhome architectural style, because right, people don't care about the other part, the whole do we own in general, people don't care about the airspace ownership or the ground up ownership. Architecturally, they want a townhouse that feels like a regular home. They're normally 2 stories. 3 stories are very popular here. They've typically got a garage. Condos, on the other hand, are much more like an apartment. Condos meaning architecturally like a condo, which is like an apartment, typically don't have a garage, typically are 1 story and feel very much like an apartment. So seeing the softening, and so we're now talking condos that are 2-bedroom, that is the least desirable typically of the homes you own. And that's where we're seeing this price drop, right? So in the 2 areas that I have described as weak, 1 week for market reasons, the high-end luxury market, and it's also weak because, frankly, that's where all the inventory's been, is at the high end, right? So it's a double whammy. First of all, supply is being increased, and second, fewer people want to spend that money. So I think that's one reason why that's soft. And at the other end, it's strictly a desirability thing, right? It's a condo, it's 2-bed, condo stylistically, right? I'm sorry, I'm harping on that. But it's more like apartment style condo, less desirable, right? So these folks had to drop their price, 80 grand, 70 grand in order to get the thing sold. And once that thing goes under 400, I might even consider buying something like that. But anyway, okay. So let's go ahead and jump in. Those are just the actual facts on the ground emails I've gotten relating to various market items over the last few days. Next, let's talk about another piece of data that kind of supports this. Now, this is from Realty Biz. You can find them over at realtybiznews.com. The headline is, prices are crumbling in ultra-luxury real estate markets. Now, this is obviously going to talk about some crazy levels of expensive. They're talking about homes, sprawling family estate in Manalapan, Florida, had its price reduced by a massive $57 million over the past 12 months and is now down to just $138 million. There's also a mansion in Bel Air, California, that is now selling for $188 million, having previously been listed at $250 million. The U.S.'s most expensive real estate listing at the time. But while this may seem like a topic that's covering the stratosphere of real estate, something that has no relevance to us, it at least hints at the trend that we are seeing, where you don't need to put the word ultra in there. The luxury market in general is suffering. You can find this in New York, and I think the evidence we've discussed a little bit here, anecdotally here in the Silicon Valley area, is supporting that. We're simply, if you're going to see places where properties values are being dropped in terms of asking price, it's the luxury market and it's the least desirable home style market, which is the 2-bedroom condo. All right, now we're going to go ahead and cover the rest of this right after the break. We've got some very interesting data here from a few different sources. Don't go away. This is data that really, I think, reveals what's coming, and I really want you to be aware of it so you can make smarter decisions moving forward. So don't go away. We'll be right back.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We're covering a little bit more data on where the market seems to be going. We talked last time focusing a lot on apartments. Today, we're kind of focusing more on the broad market, but just more data that's indicating what direction things are going. We just talked about the ultra-luxury market that I think also gives us some pretty good perspective into what is simply going on in the luxury market. And the luxury market is different everywhere, right? That price range. Now, in my area, luxury market tends to kick in over 1.3 million bucks. And of course, can go all the way up. I've got I think the most expensive listing here in Morgan Hill right now is like $6 million. It's been on the market for quite some time. I think that guy's going to have some trouble. In my opinion, it's overpriced by a chunk. But the luxury market may be a different price for you. If you live in a place where the average price of a home is $200,000, luxury homes might be the $500,000 mark, right? So get a hold of a real estate agent or grab onto whatever data you feel comfortable using and get a feel for where that line is, because you'll be able to find it. At some point, you're going to see homes that are being dropped in price in your market more than homes that are just 100,000 cheaper or 50,000 cheaper. And that's where your line is, right? That's the line between everybody else and the luxury market in your marketplace. Okay. So we already talked about that. The next thing I wanted to hit is, I think, one that really displays the dynamics of what we're doing and what we're seeing in the marketplace. And I also think this is something that's going to be very interesting to get into more in a more detailed way with the show I'm planning to do relating to the marketplace that'll likely be a YouTube video. Now, the headline is California Bay Area home sales decline 11% year over year in August. Inventory up 5% year over year. That's pretty darn interesting. It is slightly less than totally informative because prices also stayed the same or increased in most of these areas. But there's some interesting data to tease out of this. But I think it also harkens back to what we were talking about before the break. Remember, I talked about where you are in a marketplace, the distance between the supply and the demand, and how the demand was really super high. We were seeing all kinds of crazy stuff. We were seeing data like 11% sales declines and inventory staying about the same. And that was because there were the demand simply was out. It had nothing to do with people not buying. It had more to do with the demand just outpacing the supply by such a huge margin. I think that what we're seeing is a shrinking in terms of, think of it as number of buyers per homes on the market, right? Let's say before it was 15. Well, now let's say it's 4, right? So we're still at a place where property is still going for ridiculous prices, but not as ridiculous as before, right? Because we're seeing a shrinking of how high above the supply line demand is, right? They're coming more in line with each other. So let's get some of the interesting tidbits from this article. Now, if you want to check this out for yourself, it's provided by the good folks over at calculatedriskblog.com, so check that out. Bay Area home sales decreased by 11% year over year in August, the second largest decline following June 10th percent drop, dragging year-to-year date sales down by 2%. Inventory continued to improve, up by 5% from August 2017 after 16 consecutive months or over year declines. And that's another one we've been talking about a lot. And this is an interesting, remember we talked about pivot points? This is starting to feel like it, particularly since, what's the other data we talked about over the last week? We talked about how Sacramento and Las Vegas share almost identical performance numbers. 20% increases in inventory and right around 3% decreases in sales, right? So that's kind of those, when you see that kind of, it's not necessarily absolutely linked. It doesn't, but it sure does show an interesting trend that transcends a smaller market or a localized metro area. All right. 80% of the supply increase came from more inventory in Santa Clara County, followed by Sonoma and Alameda counties. And the fact that they include Sonoma as a Bay Area county kind of surprises me. I guess it is. So Santa Clara County is where I live. Santa Clara County is Silicon Valley. All right. So when you talk about Santa Clara County, you're talking about a very large area where all the big tech companies are, right? San Francisco is not where all the big tech companies are. A lot of big tech companies have an office in San Francisco. There are some companies that are relatively big tech players, but not typically not top 10, top 20, top 30, top 50 players, right? There's definitely tech companies there. I think eBay is there. I think Twitch is there. I think there's a couple different companies there. But if you want to talk the big dogs, right? You're talking about IBM, you're talking about Apple, you're talking about Cisco. Those guys are all in Santa Clara County. Most of the increase in inventory was for homes priced between $1 million and $2 million. Now, remember, we're talking about Santa Clara County, and I've also talked about the brand new construction that I keep seeing coming online, and absolutely it's been between $1 million and $2 million. It's actually they've been treating as affordable homes that are $1.3 million and above. Remember when we were talking about an ad I received from a builder just a few months ago? And I think that feeds into it. Now, in some of these areas where $1 million to $2 million sounds crazy, that's average price, right? There are some of these neighborhoods in Santa Clara County where 1.1, 1.2, 1.3 is the average home price, but that's not in general true. And I think if we were to do it countywide, we would find that would tip up into the luxury market. And I think that's one reason that explains what we're seeing in terms of the sales decline. And I think that it is also going to be interesting to see what happens with the prices on some of this new construction. I'm hot to see how long these new construction homes that are creeping up close to $2 million do. Are they ultimately going to have to drop their price? Because it wouldn't surprise me if that ends up being true. Next, and their final point, affordability concerns are impacting budget-constrained buyers, especially in Sonoma County. Well, it's a Sonoma freaking county. For those of you who don't know Sonoma County, I am allowed now. I have been given my Sonoma card. My son lives in Sonoma County. He goes to Cal State Sonoma. And so I've been up there enough times now. I get to complain about it. It's basically podunk Silicon Valley, or not even Silicon Valley. It's podunk Bay Area. A lot of people are going to be upset that I've said that, particularly if you're in Sonoma. I apologize. It's near wine country. That tends to be the big thing up there. So it's a very different place. So affordability concerns may be true in Sonoma County. They're true everywhere. I think people are paying more attention to the bottom line number and are less and less enamored with the idea of actually coughing up the money. All right, next. Redfin offered a interesting article. Redfin Housing Demand Index remains flat for third consecutive month in July. I think data like this is interesting. It's another indicator that at the very least demand is flattening. And what does that word mean? The demand flattening. It's basically another way of saying that distance between supply and demand is narrowing, just like we talked about a minute ago. So in other words, the amount of supply that's out there is much closer to meeting the demand than it used to be. That's what they mean when they talk about flattening, because that's what's happening, right? The two curves are kind of coming together and they're getting flatter. Let's see. Redfin Housing Demand Index remained roughly unchanged at 120.3 for the third consecutive month in July. Inventory declines continue to moderate, allowing buyers to be more selective. Compared with June, 1.1% fewer people requested home tours, and there was a 12% drop in the number making offers. A handful of metro areas, including Chicago, Boston, and Phoenix, posted month-over-month increases. And remember, whenever they say month-over-month increases, do not give that much weight. It's year-over-year stuff you want to hear about, because when we're talking about the month of July, month-over-month increases just make sense. Right? An increase from June to July makes sense. That is a normal seasonal occurrence. So by saying that happened in Chicago, Boston, and Phoenix, you're basically saying water is wet, right? The sexy number would be if we saw things not having a month-over-month increase in terms of metro areas during that same time frame in most areas, right? There may be some areas where that trend isn't exactly the same, but in most areas it is. Okay, demand across the 15 metros included in the demand index was overall unchanged as a result of declines in the major metro areas in California and Seattle. There's no other real sexy data here. The chart's kind of cool, I guess. The demand index is down from a peak, a national peak of October of 2017, where it saw a dramatic decline up until it hit its bottom in April 1st of 2018. And now and then in May it jumped up a little bit, and it's been flat ever since. But we're still historically high, looking all the way back to 2014, according to the good folks at Redfin. The last time we just left that whole September 1st, 2017 thing a year ago. That was the peak since 2014. The last time we were at the level we're at now was right around January of 2017, as we were on our rise up to the new highest peak in that period. And then the last time we were at this level was right around February 1st of 2015. And so the time between February of 2015 and January of 2017 is all really lower housing demand. And I can tell you, as a guy from the Bay Area, this data does not hold up at all. 2016 was nuts. The demand way back in 14, yeah, okay, we could maybe make arguments about that, but this absolutely doesn't reflect the reality of my area. So it's also something you might want to get a handle on for yourself. I'll skip all the stupid stuff. Market by market, there were wide variations in the direction of year-over-year inventory changes. Remember, year-over-year is what we want. That's why I jumped to this, because this is the sexy numbers. With double-digit increases in Seattle, 28.6%, Portland, 22.8%, and San Diego, 17.3%, as well as large declines in Phoenix, down 13.1%, Austin down 4.9%, and Chicago down 4.4%. Let's see. And that's the general demand numbers, what they're talking about. All right, so that's really it for the folks from Redfin, but I think those are interesting numbers. We actually talked about some of the other interesting declines in Phoenix, Austin, and Chicago in a show, I think, last week. Finally, let's hit one more, because why am I doing this? Why am I going and getting data from a bunch of different sources? Because I want you to get a feel for the trend. What tends to be the data that we're seeing? This one comes to us from National Real Estate Investor. These are the folks I've started paying attention to more recently, and I think I suggested you tune in yourself either earlier this week or last week. Manhattan landlords sacrifice higher rents to fill apartments. This is it. We're seeing stress on apartments everywhere. And remember what we were talking about just a year and a half ago about apartments in New York and other areas, how crazy the rent rates were. And whenever you see something like this, a trend like this, just like we talked about last time, if you're someone who is renting a property where you consider apartment dwelling options competitive to what your property offers. So let's say you are what I refer to as an architectural condo, meaning a living environment that emulates a typical apartment. you're clearly in competition with an apartment complex, right? So you're more sensitive to what happens in these markets. And the idea that these folks are having to give more and more incentives and are giving more and more incentives should scare you, right? So, and I suggested you consider reallocating your investment. All right, the median rent, the value of those concessions subtracted, fell 2% to $3,310 according to a new report. It was the third straight month with a decline. All right, so we've talked about this before. We've talked about some of these numbers, and oftentimes I'll finish my discussion with, can't wait to see what happens next month, right? Because you want to see what a trend is. 1 month can be a glitch. 1 month can be a hiccup, right? Who knows? You start to see a trend that lasts more than 2 months, that's the time to start thinking, well, you know what? There might be something real to pay attention to here. Well, we've hit that point in Manhattan, which is considered one of the strong rental markets. Manhattan apartment vacancies dropped in August to the lowest level in more than 4 years as landlords facing the end of peak leasing season focused on filling empty units before the slower winter months arrive. So they finally got their vacancy rate down to a great 1.58%. Down from 2.27% a year earlier and the lowest since May 2014. Now, all that actually sounds like good news, right? But it's the fact that things are moving in the down direction, that rents in general are moving in a declining direction. Is it 20%, 30%? No, it's not, but it's a trend. And that's something we need to pay attention to. And it's early enough in this process that if you're looking at these numbers and paying attention to it, and you can absolutely apply these ideas to whatever market you're in, right? We talked about it a little bit more on our show on Wednesday. But these are absolutely things you can integrate into your own decision-making process, learn more about what's happening in your market where you own these properties, and figure out how this influences you, how you might lose a tenant to one of these apartment complexes that are offering these incentives that we've talked about. Okay, there was nothing else super sexy in this one. Owners offered sweeteners such as a month free rent, payment of broker's fees. That's weird. I guess broker's fees are much more common in New York. There's never broker's fees here typically in California. I think primarily because real estate agents aren't usually involved in those transactions out here. 35% of new leases in August had sweeteners in August, up from 24% from a year earlier. Miller, Samuel, and Douglas Elliman said the median rent with the value of those concessions subtracted fell 2% to $3,310. Third straight month of decline. All right, so there you go. So what should you be thinking? Well, I think for those of you who own properties in these areas where you might be getting challenged, you might be getting tightened in terms of the grip around your throat by some of these changes, be aware of it, right? Knowledge is power, as we keep saying. So just figure out if these weird fluctuations in the apartment world are things you need to worry about as an owner. If you are someone who's looking to invest, I think that investing in a property that would be classified as in the same desirability bracket as an apartment, don't do it. I would not. You need to take the next step and think in terms of what's the upgrade for this, right? What the desirability of your property should be above the place that's having the biggest problems. And these places look like they're having problems and look like this may be a longer lasting trend. You as a buyer or a renter, what should you do? Take advantage of this stuff. If you're somebody who's looking to rent a place, it sounds like now is the time when you've got room to negotiate some great concessions, or maybe not even negotiate. You hate negotiating? They're offering them right out of the chute on some of these places. So take advantage of that. Now, as an investor, what should you be doing? This is a great time to use data like this to talk down the price of a multi-unit purchase. Let's say you're looking at a fourplex, or a duplex is a little tougher to do, but let's say a fourplex or more. I think you could get away with this. Point to data like this and say, listen, here's my offer, and here's what, because this is math, right? Once you get into multi-family units, multi-family properties, it's all math. None of it's like, oh, well, you know what? The couch isn't going to fit in this room, or I really hate the color of the kitchen. None of that stuff matters. Nobody cares. It's all about the math. If you cannot buy it and rent it and have return on investment be reasonable and be in the green every month, et cetera, et cetera, et cetera, you're not going to buy it. It's an investment property. It's not I'm going to live there property. It may be. Maybe you're planning on living in one of the units. But from a standpoint of doing the math, doesn't matter. Okay, so... And it's all about data. So now you've got data, 3 months worth of it in this marketplace, and you've Just because I'm talking about big old marketplaces with these articles doesn't mean you can't dig up the same data in your local marketplace. Use this as fodder for your offer. Go in there, make your offer, make it aggressive, come in below asking price and say the market's softening. This is what we're seeing. We're seeing declines in some of the most popular rental marketplaces. Multifamily is taking it in the ear right now. And the all these different apartment complexes are having to offer incentives and all this stuff in order to get their vacancies filled. So, the amount of financial loss I'm going to suffer in dealing with this property is greater than you had to deal with in the numbers you're reporting, right? Because whenever you're doing a purchase of a multifamily property, you're normally getting at least 1 year's of operating income and expenses out of that to review. So just let that be fuel to the fire where you are negotiating down what you project will be the actual income based on what you're seeing in the marketplace. All right? I think that's it. That was pretty good. I feel good about that. Maybe it's because I've had too much coffee, but I'm going to go with it. Thanks again for listening, everybody. I hope this has been valuable information for you. As is always the goal, I definitely want to leave more value on the table than you invested in time. Hope we achieved it. Thanks for listening. Talk to y'all next time.